Hello everyone, welcome back. Retirement is supposed to be the most peaceful phase of life, but for many people, it becomes the most financially stressful. Markets fluctuate. Inflation eats purchasing power. Headlines scream crisis after crisis. And suddenly, the question is no longer how to grow money, but how to make it last. Today's video is not about chasing returns. It's not about speculation. And it's definitely not about complex portfolios. If you are retired or approaching retirement, there are only two asset classes you truly need to protect income, preserve capital, and sleep well at night. Everything else is optional. Let's break this down carefully. Before retirement, growth is the goal. After retirement, survival and stability become the priority. You no longer have decades to recover from crashes, a salary to refill losses, high risk tolerance in retirement. Volatility is the enemy, not opportunity. Your portfolio must work for you consistently, quietly, and predictably. Most retirees make one fatal error. They invest like they are still 35, too many assets, too much complexity, too much exposure to market shocks. The truth is simple. Complexity increases risk in retirement, not safety. Some of the most successful retirement portfolios in history are built on two core assets only. Why? Easier to manage, easier to rebalance, easier to emotionally tolerate during crises. Simplicity is not weakness. In retirement, simplicity is strength. Asset number one, high-quality income-producing assets. In retirement, income replaces your salary. Capital gains are uncertain. Income is predictable. Your first asset must pay you regularly, regardless of market conditions. This includes dividend-paying blue-chip stocks, dividend ETFs, government bonds, investment-grade corporate bonds, fixed income funds. The key is not yield, it is reliability. Many retirees fall into yield traps. Unsustainable dividends, junk bonds, over-leveraged funds, high yield without quality leads to capital destruction. And once capital is gone, income disappears. Companies that have paid dividends for decades, have increased dividends through recessions, operate in essential sectors. These are not exciting, but retirement is not about excitement. It's about consistency. Bonds are not about returns. They are about stability. During equity crashes, bonds often rise, income continues, emotional panic is reduced for retirees. Bonds act as a financial seatbelt. Asset number two, real assets that protect purchasing power. Inflation does not crash portfolios overnight. It slowly erodes living standards. Retirees feel inflation more than anyone because income is often fixed, expenses rise permanently. That's why your second asset must protect purchasing power. Real assets include gold and precious metals, real estate, direct or REITs, infrastructure assets, inflation-linked securities. These assets retain value when currency weakens. Gold does not generate income, but it performs one critical function. It preserves wealth during crisis. Wars, currency debasement, debt explosions, gold has survived them all. For retirees, gold is not an investment. It is insurance. Rental income adjusts over time. Property values rise with inflation. Even indirect exposure through REITs gives retirees steady cash flow, partial inflation protection, asset backing. Real estate anchors portfolios in the real economy. High-growth stocks are volatile, depend on market sentiment, require perfect timing. Retirement portfolios do not need 20% upside. They need 0% disaster risk. Retirement is as much psychological as financial. Income assets reduce anxiety. Real assets reduce fear of inflation. Together they lower stress, reduce panic selling, encourage long-term discipline. Peace of mind has real financial value. History shows Income assets stabilize cash flow, real assets protect value during recessions, wars, and inflationary shocks. This combination consistently outperforms overly aggressive portfolios on a risk-adjusted basis. While exact percentages vary, many retirees use majority allocation to income assets, smaller but meaningful allocation to real assets. The goal is balance, not optimization. This approach works whether you live in the US, Europe, Asia, emerging markets, because income and real assets are universal financial needs. Cash is necessary for liquidity, but long-term cash holdings lose value. Cash supports the system, it does not anchor it. This approach avoids timing the market, chasing trends, emotional decisions over trading. Retirement wealth is preserved by what you avoid, not what you chase. You do not need 15 ETFs, daily trading, constant monitoring. You need reliable income, inflation protection, emotional stability. In retirement, wealth is not about how much you make. It's about how long your money lasts and how peacefully you live. 2 assets, 1 simple framework, timeless principles. Markets will change, headlines will panic, but disciplined simplicity has carried retirees through every era. If this helped you think more clearly about retirement investing, subscribe for more long-form, research-driven insights. See you in the next one.